My name's Alan Harber. I'm the area director, as it says up there, for Sussex, so cover East and West Sussex for Lloyds. Commercial banking, so I'm not going to try and get too hung up on what sector we deal with and what we don't deal with. I think the key is we deal with it. So whatever the business turnover of you or any of the companies that you may well be associated with, we will have a facility that will be able to support that company. So from small, really small businesses right the way up through. So didn't want to get too caught up there. When Harber kindly offered me the opportunity to come and speak to you all and ask, what are you going to talk about? I thought we'd just begin with funding, but I didn't want to get too caught up there because people quite often just associate a bank with coming to get some funds. So you may well bank elsewhere, which is completely fine. That is your choice. That's the beauty of this great nation. But what hopefully I might be able to do is just explain a few things that you should just check in with your current banking arrangements to make sure that you're getting those. And obviously, if you're not, we'd love to talk to you. Joined in the room today, I've got a couple of colleagues of mine that work alongside me. So I've got Colin Grant, who's a local banking manager. Colin's just over here. So if after this you've got any general banking questions, he's your man. And if it's more property related, I've got Elliot Brown. So he looks after anything to do with property investment and property development, and I'm going to touch on his specialism just there. So before we get wound into debt, which is one side of the balance sheet, obviously you've got deposit funds as well. I guess this is one of the things that I see day after day is that businesses will hold their funds and say, we'll have a conversation with them around, so what do you do with your deposit, and tell me about what's your strategy, what kind of funds do you need, a 0 to 1 day, have you got a 30-day plan, have you got a 90-day plan? And they go, yeah, I've got some money and it's in this account over here. And what's your interest rate? There's kind of a bit more to it and there's a bit more finesse, and I'm not going to be able to touch on that today just because of time. But again, if you'd like a bit more information, we've got a fantastic tool publicly available, which will run you through various options and work out whether your money's working right for you. 30-day notice accounts, maybe a 3-month, 6-month, 12-month, what the rotation is, and it'll work it all out for you and show you what your cash management position is on any given day. And whilst that's not the most exciting subject to go through, it is one of those things that I'm just at pains to point out to people that you really should have a plan for that. So more than happy to run through that with anyone. So having presented in this room before and knowing that the budget still is somewhat tight, that we've got Hamid's bedroom TV in this one, there's no death by PowerPoint, I'm really pleased to say. So that's it. So it doesn't look like the greatest presentation, but hey, let's see where it goes. The reason I've got security there in the middle, that will be the key driver for you. So if you're looking to borrow money as a business, normally there's two things. One, what's the security you're prepared to give? So what collateral have you got? Is there anything in the business? We then start talking about personal homes. What's the lending value in that? And the other part will be the repayment method. So that will be a case of looking at the accounts and seeing what ability, what cash is available for debt servicing within those accounts. But there are other options. So quite often people will come to us and just say, I need to borrow some money. And then we'll have a chat through what the reason is. And funny enough, as you might well expect, each one of those reasons is slightly different. But quite often the solution is exactly the same, which is surely I'll just do a term loan. So right at the bottom of that screen there is term debt. Stereotypically, that should be offered up to a 25-year tenure possible. It can be for a variety of courses, cases. Could be an MBO, could be a change of premises, could be cash flow. We'll lend for a number of set criteria. So we've got healthcare specialists that work alongside me within my team. So that could be dental, pharmacy. We can lend against scripts. We can lend against a number of GP practices, whatever that could look like. Just done a loan on a fishing boat. So using fishing quotas and fishing licenses in order to support. So don't just think that cash is the only way of showing repayment. it could well be through a different instrument that allows us to term that one out. You're probably interest rate wise on all of these. You could do, I mean, right now that's a $1 million question in terms of what's going on with interest rates. We were covering that yesterday, and again, I was going to go through interest rate management today because you could fill an hour on that really quickly. You may lose a few people, but we can fill an hour on interest rate management and what's going on in the market right now. If you've got any foresight into the market, over the last day, the charts have just gone crazy. And I haven't checked this morning, but I can pretty much guarantee they're going crazy right now in terms of where we see our position and what's happening. And all of that will make an impact on what fixed rate, what variable rate, you may go for a capped rate, or another highly underplayed moment is you can do a mixture of both. So you could do part of your loan fixed, you could do part of it variable. A lot of people do, and again, we'll provide you with the information that you may need in order to be able to reach an informed decision on that one. So moving swiftly on from term debt, another really great way of looking at it is asset funding. Might be known as HP to a number of you. We have an in-house ability of creating those. It's a quick way to money. We can set up a facility for you so you can draw down from it. So we may give you a limit that you can go up to for your business or your client. So if they need to purchase equipment on a regular basis, this is a really good way of doing it. And having a preset limit means you don't have to go out, look at said piece of machinery, and then come back and see if you've got the funding. In effect, we'll agree it in principle up front for you so that you can draw down against that. The good news is the security used will stereotypically be the asset. So it allows you to retain that security value for the term debt. So that's another really popular way of doing it. We'll do a VAT bridge for you. So if the machine is, or a piece of equipment is VATable, to allow you time to reclaim that VAT back, we'll actually fund out the VAT for you as well, which is another quite useful one. The sorts of things, obviously anything with wheels is generally quite good news with HP, but don't get caught in that trap. Machinery, dental chairs, good grief. I can't think of anything that we haven't had someone come and talk to us about and saying, can you do HP on that? 9 times out of 10, the answer will be yes. The key bit is it needs to be recoverable and fixed. So by fixed, I mean fixed within the UK. So helicopters generally are not a great place to be because they have that ability of disappearing fairly quickly. Serial numbers are tricky, and trackers. There are specialist brokers out there that will do that for any helicopter enthusiasts out there, but do just keep that one there. So again, HP really good, low deposit, fixed monthly payments, stereotypically, good interest rates on those, and again, you're not using the security that you may well have given up to achieve the term debt. Now, one that I think more and more people are aware of right now is property development and property investment. I'm going to touch on this briefly, but again afterwards, Elliot is right here. He loves the property question more than life itself. See if you can catch him out. It's generally quite good fun. Sadly, he does tend to know the answer. But just really quickly, so our property development proposal within Lloyds, the amount of clients I go out and meet, so you may well have a property development interest alongside your business. We go out, we talk to the client, and 9 times out of 10 we hear those words of, "Oh, we didn't know Lloyds were into property development." And as we kind of just mop our brow and think, here we go again, I just wanted this opportunity of just sharing it with you. We're very much into property development. We've got some really good proposal, but bringing it together really briefly, 65% of costs is what we'll do, and that's all costs. The only cost we won't do is estate agency fees, because they're seen as a post cost on the build, i.e. you know, hopefully it's finished and you should be able to bear those costs and our own interest. Our interest is collected monthly on that loan. But of those costs, you might have solicitors' fees, finder's fees, you could have any of the fees associated with the planning application, right down to the actual build itself. So it's 65% of all costs that you'll incur in creating that property development. In terms of lower and upper limits, give us that challenge. Our upper limit within our own segment is around about 8 million in terms of single point property development, but it's worth having a conversation with us if you've got something going that's outside of that. We'll do tranche drawdowns on that, so you'll take the money as and when you want as we go through. Some of that may be surveyor monitored, some of that can be monitored by us. It just depends on the type of debt that we're looking at. It's 12 to 36 months repayment profile. So again, when you're going around and you're looking, and there was a great question raised yesterday about why are interest rates and aren't all banks the same? Absolutely not. Not all lenders are the same on this one. So if the development's going to take 18 months, we may agree with you up front that we'll do this funding for 2 years or 2.5 years. Why would we do that? It will give you time to get back out of the development, whilst I'm sure it will sell on day one, and everyone, there'll be a large queue up. Just in case that queue doesn't form, we will give you the ability of not having to force into a stressed sale and start discounting your goods in order to get out of it to repay the bank. The other key point here is there's no exit fees either on this one. So currently we've got no exit fees. Again, when you're checking with this lender that may look at a better rate, just check that there's no exit fees on that one, and that they'll also give you that flexibility. On property investment, HMOs, flats, commercial, resi, you name it, we again really keen on looking at those. We haven't got too many outside. Our USP on this one is our PAL product, so that's a partially amortising loan. Now again, Elliot will explain this far more eloquently than me, and I purposely haven't done his slide. What we're really looking at there is a 30-year repayment, up to a 30-year repayment profile, but with a 5-year bullet. So in effect, the term will be 30 years, so that will be how long we'll stretch that loan out over, but it'll be on a 5-year repayment profile. So what that helps you do is bring down the cost of that fund. What's in it for us? Well, we've got a lower commitment in terms of time commitment, and you'll find the interest rate is somewhat more favourable. It tends to be up to, it's probably really low 3s, could be late 2s, just depends where we are, what the loan is, over what period, etc., etc. But that PAL product, in particular on investment, is absolutely one that you should explore before committing yourself to any other lending. Some of our competitors might look for a revaluation of property, in particular property investment, during the term of the loan. That's not something that we entertain. On most, obviously there'll be extremes, but it's very unlikely that we'll want a revaluation.
So, do you do interest only on development or HMOs?
So on development, property development's interest only. Not an investment, that'll be on a repayment process. But that's where this PAL product's worth a look, because of the tenure and the term that it runs over. Actually, it's a really competitive market out there, really competitive product for you. So definitely one to pick up with Elliot over a cup of tea. So moving on through vehicle fleet. So a lot of people don't see a fleet as a great way of raising funds. So we work with a partner called Lex Auto Lease, one of the biggest in the UK. So the sorts of things we can do there is, if you've got a fleet that you own, a fleet of vehicles, we can actually purchase that fleet back and put it into a vehicle leasing arrangement. Now check, obviously with accountants out there, but that could well take it off balance sheet and be an advantageous tax position. It's not for everyone, it's not for, I'm not saying you should do it every single time, but it's one of those things that's worth going around the loop and just having a quick look. The other bit around your vehicle fleet is the liability you've got. Now, I'm sure Ahmed will be able to give you a far better update on that, but you do have a number of obligations. If you're supplying a vehicle to a colleague that's working for you, you've got service issues in terms of, if they have an accident in any way, shape and form, you will need to provide what the service schedule is and what you did to protect them and how that worked. We'll do vehicle management. We can go from fleets from 1 or 2 right up to a couple of hundred, 300, 400, 500, you name it, we can provide it. But that fleet management's really good. With the onset of the environmental challenge that we've all got out there, we also work with a company called Drive Electric. They'll go through how that works for you as a business and whether it's the right decision for you, and we provide that consultancy basis. So we can run through your fleet and look to see whether now is a good time for you to consider the electric alternative and how that would work for you, any cost benefits. that's another really good one to just consider. So again, you're not using any of your own capital in terms of giving up security on those, because security 9 times out of 10 will be taken against the vehicle that will be supplied. And again, it will be on a rental basis. So again, that can push money back in. So your vehicle fleet is one to consider. Card services might not look like an obvious one to be able to raise funds. So if you have card terminals, so you may take payment within a business, or one of your clients may take payment via cards in the business, we offer next day settlement on that card balance. So we're one of the only people in the market to do that. So as long as it's in before 6 o'clock in the evening, following morning, money's released, which can help your working capital management cycle massively. Depends how heavy use that client is on it, but do just keep it in mind in the back of your head. That could be a great way, because the industry average is 3 days, 4 days, and we'll do next day. The next day charge, quite often people will go, yeah, but it sounds really expensive. It's 21p a day, that's it. It's not 21p per thousand, it's not 21 pence on a certain amount, it's 21 pence per day. If you're a non-client of Lloyds, it's 81 pence. We also provide, there's a number of on charges with card terminal machines that you may have some compliance charges. We'll work through those with you and show you how actually you can completely mitigate that cost. And we'll show you how to be compliant in it. It's only because some companies don't quite see the value in it that you'll see that 15 or 20 pound charge for compliance or non-compliance. One thing I couldn't just do, and it's slightly off topic, but I just wanted to just cover this, is our international offering. We've got something called an international trade portal, ITP. Please do have a chat with Colin, Elliot, myself, someone. If you're a non-Lloyds customer, you can have that. If you're trading internationally, it's an absolutely cracking bit of kit. Again, a bit more time, I'd happily do a demo. Perhaps it's one for another day. But it really does bring alive, just if you're importing or exporting, if it's beer bottles and you're wondering who's a producer of them and what custom forms do I need, I've got your attention with beer bottles. But it will run that one through, and it will show you actually what custom forms you need, what the import looks like, what the export looks like, who the top producers are. It's got their telephone numbers, it's got what trade shows are there, the whole thing, and it's really, really simple. It's an absolutely cracking piece of kit, but only if you're doing anything internationally. If you're not, I wouldn't suggest it's a time stealer. And then finally, looking at working capital on the bottom left there. So this is just a bit of an open question, so no need to answer, but quite a lot of small businesses, or businesses generally, seem to act as the bank manager. So if we assume that maybe we're the only bank in the room right now, but why would a business want to operate as a bank? Because when you give any terms on an invoice, in effect, you're straight away operating as a bank. So you're giving a loan, maybe against a goods or a service or a contract, and you might well give payment terms of 30 days, 60 days, 90 days, 120 days, on or before, whatever it is. But that's putting you at stress. Quite often you haven't completed a number of checks. You may well have run them through a credit check, but you don't know what their financial system is, what their back office payment system's like, have they got any liabilities, and where do you stand? And this is one, quite often you hear people say, oh, I got knocked on an invoice, I didn't get paid on that one, this one didn't happen. Now, depending what kind of debtor book you've got, and actually we're really strong on this one, invoice finance is a really great way of going. It's not for everyone. It's one of those ones that people that haven't experienced it in the last 12 to 24 months will tell you it's a really expensive way of raising funds. So if you talk to your mate in the pub, if that's where you get your best advice, they'll tell you it isn't the way to go. I would just say, just find out about it before you make that cost. This product's fundamentally changed over the last couple of years. And I'm really proud to say that we at Lloyds hold it very dear to our heart and actually provide that solution to a number of clients. Again, that security part's really key on this one. There's no, stereotypically, we won't use your security. So again, it allows you to generate term debt should you need to from the company. It can be set up in weeks. Payment can be within 24 hours. So you'll input the payment onto a system and it will be paid the following day, depending on what your needs are. The limit will flex as you grow. So unlike an overdraft that will have a fixed limit, £50,000, whatever it could be, this can be flexed during the product term. The funding isn't limited by your ability to service the debt, which is a real key one. And the funds can be used for relatively any purpose. So one that I've recently supported a client with, was actually to help them purchase a company, so it wouldn't always be seen as the right way to go, but actually the company, the target purchase, had a really strong debtor book, had some great clients on that book, and we were able to raise funds against that. And through a short-term financial, so we're talking just for a few hours, to allow the purchase to happen, we were able to set it all up in advance and take the charge over and release the capital straight in to allow the business purchase to happen. That might not always be the way that you'd look to do it, but it absolutely worked really well for this client and allowed them to not use that security, any of their own value in order to purchase. Time period for the first 6 months on this product is 28 days, which again currently is market leading. After 6 months, it's a 3-month notice period. Again, in the market, they're really, really low. We can release up to 90% of the invoice value, depending on how it works, and whether you use invoice finance or a factoring facility. If you're starting to want to ask questions about that, you need to pick up with me offline, because we're starting to get into factoring, and that's where you want to try and stop and general discussion in this way. We'll also do 100% asset concentration, which is quite a rare one. So if you just tend to invoice to one single client, quite a lot of providers won't entertain that because they won't want single point concentration. We're happy to accept that, and we do provide facilities in the last few months where they've just been single debtor. Again, it all depends. We'll also the only mainstream lender that will look at the construction industry. So that's absolutely a sweet spot of ours, and one that we're really keen to support the construction industry. Lastly and finally is we'll also provide you with a debtor protection should that be the right thing for you. You don't have to take it, but some customers do like to go with a debtor protection policy that runs alongside that. Again, really, really strong way of working for you. So coming full turn all the way back, don't just consider term debt as the way forward. Don't just consider your bank as one point. We have boots on the floor here at Lloyds. So I've got 10 colleagues that are out on the shop floor every single day, out with clients, out with customers, both new and existing clients, looking to provide this support in. We're absolutely a UK focused bank, and we're really, really looking to try and support you all the way through. So just before I finish, I've kind of anticipated that one of the Q&A bits is going to be around Brexit, because it always is. Just thought it was worth, again, sharing with you that we do, obviously in these turbulent times, we do provide a Market Matters conference call. The next one's on the 8th of November. Who knows by then? But these, you don't have to be a Lloyds client to register for it. Again, if you're interested, drop me a note afterwards. I'll happily send you through the details. This will be an economic update. These people that will be on this call will be able to provide a really good understanding on Article 50 and exactly what's going on at that particular time. They'll run you all through it. They're on at least every month. We also pulse them, so depending on what's going on in the market, we can pulse them. We also do, you can sign up again on our website. You don't have to be a Lloyds client again. We'd love you to be, but you don't have to be a Lloyds client. We provide daily updates on this on all parts of the financial market. So if you want to know about the dollar, the euro, if you want to know about fixed rates, if you want to know what's going on forward, that's all there for you. So again, I can get you registered. So thanks for listening. Been really great to come along and meet you. Always an absolute pleasure to work alongside So Legal and all of the colleagues there. So any, hopefully, simple questions that I can pass to either Elliot or Colin? Hopefully. Brilliant. I'll hand back. Allow me to do so. Thanks very much. Thank you.